Can a company really automate 95% of healthcare delivery using AI and tech? I mean, really. And maybe more importantly, can that level of automation actually build a durable, a long-lasting competitive moat in today's world? That's what we're going to unpack today. We're diving into a company with a compelling vision, but also some pretty crucial questions we need to explore. Welcome to the deep dive. This is where we take your sources, articles, research, maybe even your own notes, and pull out the most important bits of knowledge and insight. Think of it like your shortcut to being genuinely well-informed. We try to pack it with surprising facts, maybe a little humor, just enough to keep you hooked. Our mission is really to guide you through the material, help you understand what actually matters. So today we're doing a comprehensive deep dive into Hinge Health, Inc. They trade on the New York Stock Exchange, ticker symbol HNGE. This is a company positioning itself as a leader in digital musculoskeletal care, MSK care as it's often called.
Exactly. And what's really interesting here is how we're approaching this. We're aiming for that kind of Buffett-style look, a really thorough examination of the business itself, its management, its intrinsic value, all based on publicly available info. And just for context, all the data, financials, market sentiment we'll talk about, it's all current as of August 21st, 2025. The stock closed yesterday at $55.76 per share.
Okay, great context. And we structured this deep dive into two main parts to make it easy to follow. Part one, we'll build the foundation, look at the business model, management, the financials. Then in part two, we'll zoom out a bit. We'll cover market sentiment, who owns the stock, those crucial risk factors, before tying it all together in the conclusion. Sound good?
Sounds like a plan.
All right, let's get started then. Let's unpack this with chapter one, the business of digital recovery.
So fundamentally, Hinge Health operates on a B2B model, business to business. That's really core to their whole growth engine. They're not really going after individual consumers directly. Instead, they target large self-insured employers and health plans. Those are their main clients.
Okay, so they sell to the company, not the person.
Pretty much. Once they sign a contract, that employer or health plan offers Hinge Health as a covered benefit to their employees or members. And this structure, it creates a really capital-efficient sales approach. Think about it. The client, the employer, or the health plan, they're both the payer, and they act as a key marketing and distribution channel for Hinge.
Ah, because they want their employees to use it to save money.
Exactly. They're incentivized to promote the service because Hinge promises significant cost savings on their overall healthcare spending. It's quite clever, really.
That B2B model does sound incredibly efficient for Hinge. But okay, let's flip it. From the user's perspective, the employee, the health plan member, what are they actually getting? Because it sounds like more than just an app, right?
Oh, definitely. They position themselves as a comprehensive digital musculoskeletal clinic. It covers the whole spectrum: prevention, acute pain, chronic pain, even rehab before and after surgery.
So what's sort of inside this digital clinic? What are the components?
Well, the core is a mobile app, yeah. But it delivers personalized exercise therapy, education, and crucially, direct communication with a pretty robust care team. We're talking doctors of physical therapy, PTs, physicians, board-certified health coaches, whole team.
Okay, so real humans involved.
Absolutely. And then there's the tech that makes them stand out. They use wearable motion sensors that give you real-time feedback on your exercises. Plus, they have AI-powered computer vision using your phone's camera, actually, to check your form. It's almost like having a PT right there in your living room guiding you.
That's pretty advanced.
It is. They also have a proprietary device called EnsoFo. It's non-invasive, uses electrical stimulation for pain relief. Not addictive, which is key. And they've expanded into specialized areas like women's pelvic health and fall prevention programs.
And didn't they just launch something new? Bridging digital and physical.
Yes, good point. That's the Hinge Select Network, launched just this summer, 2025. It basically bridges the digital and physical worlds. It allows their digital platform to refer members to vetted in-person providers if they truly need something like imaging or injections or maybe some hands-on physical therapy. It really aims to be a full spectrum of care.
Wow, that is a comprehensive offering. So given all that, how big are they actually in the market? And, how much room is there left for them to grow?
Well, their market position is, frankly, dominant in the digital MSK space right now. As of Q2 2025, they reported serving over 2,300 clients. And that client number grew 32% year over year, so solid growth. But it's not just the number, it's the quality of the clients.
Like big names.
Huge names. Nearly half, 49% of the Fortune 100 companies and 42% of the Fortune 500. These are major enterprises trusting Hinge Health.
Okay, that's impressive scale. What does that translate to in terms of actual users?
It translates to over 1.2 million active members using the platform and what they call 20 million contracted lives, basically, people who have access to Hinge through their employer or health plan, even if they aren't actively using it right now.
That's a lot of people. But how much
Yes.
bigger can they get?
This is the really immense part. They estimate they've only penetrated about 5%, just 5% of their total addressable market, the TAM.
Only 5%. Wow.
Yeah. Think about that. It's not just room to grow. It suggests they're aiming to define and really dominate a whole burgeoning category. The runway here is just massive, and it creates this powerful flywheel effect, right? Once they land these huge enterprise clients, it builds momentum, attracts more clients, generates more data, it feeds itself.
5% TAM penetration.
Yeah.
That's quite something. So if they're dominating the market but still have so much potential, what's the core pitch? What gets these huge companies and their employees to sign on? What's the value proposition here?
It's pretty clear, and it works on two levels. For the members, the employees, it's about convenient, personalized, effective pain relief, helping them move better, avoid surgery, improve their quality of life. For the clients, the employers, the health plans, it boils down to economics. Significant, verifiable cost savings, and a strong return on investment.
ROI is key for businesses.
Absolutely. Hinge Health consistently claims a 2.0x to 2.7x ROI for employers. And they say over half of those savings come directly from helping members avoid expensive surgeries, things like spinal fusions or knee replacements.
And how do they achieve that ROI? Is that where the automation comes in?
That's exactly where that bold claim comes in. They tie that impressive ROI directly to their claim of automating approximately 95% of the care delivery process. That automation is a huge economic driver for their model.
That 95% number is still pretty staggering. For anyone who's dealt with healthcare, the idea of any part being that automated sounds, well, almost revolutionary, or maybe a bit scary. What about the wider industry? Is the market ready for this?
It seems to be. The digital MSK market itself is really robust, valued at over $5 billion in 2025. And it's projected to grow at a pretty healthy clip, about 17.6% compound annual growth rate. That puts it near $16 billion by 2032.
What's driving that growth?
A few things. The rising number of people with MSK conditions, unfortunately. A broader shift in healthcare towards value-based care models, paying for outcomes, not just procedures. And, of course, the increasing adoption of technology in healthcare overall. As the established leader, Hinge Health is really, really well positioned to ride that wave.
Okay, but they can't be the only ones seeing this opportunity. Who are their main competitors?
Good question. You'll sometimes see generic business services listed, but their real rivals are other well-funded digital health platforms focused on MSK. Sword Health is a very direct competitor. They also talk a lot about ROI and use AI. Then there's Kaya Health. They're interesting because they use just a smartphone camera for motion analysis, no external sensors needed.
Different tech approach.
Right. And you also have broader platforms like Omada Health. They offer MSK care, but it's bundled as part of a multi-condition platform, diabetes, hypertension, etc.
So how does Hinge position itself against those?
Hinge's strategy seems to be, we are the best-in-class, dedicated, most technologically advanced solution just for MSK. They're focusing on being the specialist, not the generalist.
Makes sense. What about regulations? Digital health seems like a tricky area.
It is evolving, definitely. The U.S. FDA is actively working on clearer standards. You hear about things like PDUFA 7, which aims to streamline rules for medical devices and therapies. Now, while evolving regulations can create some uncertainty, the FDA getting more involved is generally seen as positive. It helps establish clear rules of the road. And for Hinge Health, being the market leader with significant resources, they're probably well placed to navigate, maybe even help shape these emerging regulations. That could actually solidify their advantage long term.
What about new companies trying to enter this space? Are the barriers high?
Oh, they're substantial. Really high hurdles for new entrants. First, there's the technological complexity. You need serious engineering talent for AI, computer vision, integrating wearables. It's not simple. Then, clinical validation. Employers demand rigorous proof that it actually works and saves money. That takes time, costs a lot.
And money itself, I assume.
Capital requirements, exactly.
Yeah.
Scaling sales teams, manufacturing devices if needed. It takes deep pockets.
Yeah.
But maybe most importantly, building those enterprise relationships, getting into the Fortune 500, building trust. That takes years. Hinge Health's existing client list, that's a formidable competitive moat right there. A startup just can't replicate that quickly.
Those are definitely strong barriers. It really does sound like they're building a
Fortress.
fortress around their business. Let's dig a bit deeper into their specific advantages then. What truly sets Hinge Health apart in this, increasingly crowded digital health field?
Okay, several key things. First, just brand strength and recognition. It's becoming known. When members see Hinge Health offered by their employer, it's seen as a big delighter, a valuable perk. Things like their Movement Awards also help build that brand.
So brand matters. What else?
Cost advantages and economies of scale. That 95% automation model we talked about, it allows them to scale the expertise of their physical therapists across a much, much larger patient base than traditional clinics. So as they grow, the additional cost per new user is very low. That should lead to significant margin expansion over time.
Makes sense. Scalable software economics.
Precisely. Then there are powerful network effects and high switching costs. They have deep partnerships with major health insurance carriers. Think of them as distribution channels. Once Hinge is integrated into a company's complex benefits system, ripping it out and replacing it is disruptive and costly for the client. That makes those customer relationships really sticky.
Hard to switch away.
Very hard. Finally, you have their unique assets. That acquisition of Wrench in 2021, the computer vision company, that reportedly gave them the largest computer vision team in digital health. That's a huge tech advantage. And related to that is their massive data set. Over 1 million active members generate tons of data on movement, pain, outcomes. This creates a data moat. More data leads to better AI, which leads to better outcomes, which attracts more clients, which generates more data. You see the cycle.
Yeah, that's a powerful self-reinforcing loop, a real competitive advantage.
Definitely.
Okay, that's a truly comprehensive picture of the business and its advantages. Now let's shift focus. Let's look at the people running the show. Time for Chapter 2, Management Evaluation.
Right, leadership. Hinge Health is founder-led. Daniel Perez is the CEO. Gabriel Mecklenburg is executive chairman. They actually started the company back in 2014, apparently inspired by their own experiences with MSK injuries.
Always interesting when founders have personal connections to the problem.
It often brings passion, yeah. But beyond the founders, they've built out an executive team with seasoned operators, people who've worked at places like Google, Facebook, GE Healthcare, even Livongo Health, another successful digital health company.
So a mix of founder vision and experienced C-suite executives.
Exactly. That blend is often seen as a strength for scaling up a high-growth company like this. They also showed pretty proactive communication during that Silicon Valley Bank scare back in March 2023, which helped build some trust through transparency.
Okay, that sounds like a strong team on paper. Experience, founder-led, good communication. But I came across some data, I think it was on Comparably, that painted a very different picture internally. An F rating for the executive team. Only 33% approval from employees. That seems like a really stark contrast to the polished external image. How big a red flag is that, really? Could that kind of internal issue genuinely impact their ability to keep top talent, innovate, or even just execute on this huge opportunity?
That's an extremely sharp observation, and yes, it's a critical point to watch. That disconnect between the external narrative and reported internal sentiment is a major red flag, no question. Think about it. This is a company that relies incredibly heavily on cutting-edge technology, continuous innovation, and also a high-touch clinical team providing empathetic care. Talent retention in all those areas is absolutely paramount.
So low morale could really hurt them.
It absolutely could. A low executive team rating like that can signal underlying problems, maybe with morale, maybe lack of clarity in vision or strategy, maybe even just basic day-to-day execution. Any of those could potentially erode their competitive advantages over time. So while the external story, the growth, the tech, it's all very compelling. But ignoring those internal sentiment indicators would be a big mistake. It definitely warrants serious attention as a potential risk, a potential drag on their long-term success.
That's a really crucial counterpoint to consider. Okay, moving on to how they use their money capital allocation. It sounds like management is investing heavily back into the core business.
They are, very heavily. Just look at R&D spending. In the first half of 2025, it was over $300 million. That's a 5-fold increase from the same period in 2024.
Wow, 5 times.
Yeah, it signals a really clear priority. Maintain product superiority, stay ahead of the tech curve. Their M&A strategy also seems quite targeted. That Wrench acquisition in 2021, that was clearly about buying technology and top talent, not just bolting on revenue. And it's worth noting, the proceeds from their IPO back in May 2025, They stated the plan was to use that primarily to handle tax obligations related to employee stock units, RSUs. That's a pretty standard, prudent use of funds right after going public.
Makes sense. And given they're growing so fast, are they paying dividends or buying back stock?
Yeah.
And what about return on invested capital, ROIC?
No dividends, no share buybacks. And that's entirely appropriate for a company at this stage. You'd want them reinvesting every available dollar back into the business to capture that huge market opportunity. Remember, only 5% TAM penetration, revenue growing over 40%. They need to fuel that growth.
Right. Reinvestment makes sense. What about ROIC?
Standard ROIC calculations aren't very meaningful just yet. That's mainly because they still have significant GAAP net losses, largely driven by those big non-cash stock-based compensation charges from the IPO. However, remember that client ROI we talked about? That 2.0x to 2.7x return they delivered to employers by cutting healthcare costs. You can think of that as a really strong leading indicator of the underlying value Hinge Health is creating. It suggests that once they reach greater scale and achieve sustained GAAP profitability, their own ROIC metric should become very, very compelling. The value creation seems to be there, even if standard accounting metrics don't fully capture it yet.
Okay, that's a good way to look at it, leading indicator. From leadership and capital use, let's move straight into the numbers. Let's dive into Chapter 3, financial analysis.
All right, financials. As of our snapshot date, Hinge Health's market cap is about $4.4 billion. Interestingly, its enterprise value is slightly lower at $3.99 billion.
Why the difference?
That difference means they have a positive net cash position, about $403 million more cash on hand than debt. That's a really healthy financial cushion. They're classified as a mid-cap stock, suggesting plenty of room still to grow.
And revenue. You mentioned strong growth earlier.
Explosive and actually accelerating. Revenue was around $293 million in 2023. It jumped to over $390 million in 2024. That's about 33% growth. But then look at Q2 2025. Revenue hit $139 million, which was up 55% year over year. Significant acceleration. And their guidance for the full year 2025 is between $548 and $552 million. That's around 41% growth at the midpoint. The market adoption curve seems to be steepening.
That is strong top-line growth. What about profitability, margins?
Okay, margins are a bit nuanced here. First, gross margin. In Q2 2025, their GAAP gross margin was a healthy 70%, but their non-GAAP gross margin was an exceptionally strong 83%.
83% non-GAAP gross margin. That's very high.
It's fantastic. It really signals a highly scalable, software-like business model with excellent unit economics. Now, when you look further down the income statement operating margin, net margin, you'll see deep negative numbers on a GAAP basis.
Why is that if gross margin is so good?
It's primarily due to massive non-cash charges, specifically stock-based compensation, SBC, related to their IPO. We're talking hundreds of millions of dollars in SBC expense hitting the GAAP P&L in recent quarters.
So it's an accounting charge, not cash leaving the business.
Largely, yes. And that's why looking at non-GAAP figures is important here. If you strip out those non-cash items and some other adjustments, Hinge Health actually reported positive non-GAAP operating income of over $26 million in Q2 2025. And they're guiding for $77 million to $83 million in non-GAAP operating income for the full year 2025. So the underlying core business is generating cash profit.
That's a critical distinction. Is that showing up in free cash flow?
It is. There's a positive trend there, too. They generated $45 million in free cash flow in 2024 and another $32.6 million just in Q2 2025 alone. The business is becoming self-funding, which is a great sign.
Okay, that clarifies the profitability picture. GAAP versus non-GAAP is key here.
Yeah.
So considering they're self-funding now, how stable is their overall financial position? Balance sheet health.
Well, first, earnings consistency on a GAAP basis isn't there yet. As a recently public high-growth company, they're still showing those GAAP net losses due to heavy investment and those IPO charges we discussed. The key milestone ahead is achieving sustained GAAP profitability.
But the balance sheet itself?
Exceptionally strong. Probably one of their biggest financial strengths. Their debt-to-equity ratio is negligible, just 0.03. They are virtually debt-free. They have over $413 million in cash and equivalents versus only about $10 million in total debt. That gives them immense financial flexibility to invest, acquire, or weather any downturns.
And liquidity.
Very healthy. Their current ratio is 1.91, indicating they have plenty of liquid assets to cover short-term liabilities. And, as we mentioned, no dividend. They're reinvesting everything for growth, which is appropriate right now.
Okay. Strong balance sheet, self-funding, but path to GAAP profitability is the thing to watch. Now, valuation. How does the market value this growth story?
Right, valuation. Given the negative gap earnings, a standard price-to-earnings PE ratio isn't meaningful. So people often look at the price-to-sales PS ratio. Hinge Health trades at about 9.3 times its trailing 12-month revenue. Now, that's definitely a premium compared to the broader U.S. healthcare sector, which averages around 1.1x sales.
So nearly 10x sales versus 1x for the sector. Why the premium?
It's justified, or at least rationalized, by that rapid revenue growth we saw 40% plus projected for this year, combined with those very high gross margins, 83% non-GAAP, and their clear market leadership position. The market is paying up for growth and quality.
Okay, that's relative valuation. What about trying to estimate its intrinsic value, like using a DCF?
A discounted cash flow, or DCF model, is a useful tool here, yes. It forces you to really think about the long-term assumptions. You estimate all the future free cash flow the company might generate and then discount it back to its present value. Now, DCFs are very sensitive to inputs, so we should treat specific outputs as educational, not definitive. But one such educational DCF model, based on reasonable assumptions, suggested a potential fair value for Hinge Health of around $127 per share.
$127. Compared to the current price, around $56.
Yep.
That implies significant undervaluation.
It implies that, yes, but again, huge caveat. That $127 figure is highly dependent on the assumptions baked in. You'd need to assume sustained high growth rates, maybe starting near that 41% guidance and gradually tapering down over many years. You'd also need to assume significant margin expansion, eventually reaching profitability levels similar to mature software companies. And you need to pick an appropriate discount rate to reflect the risk. Change those inputs even slightly, and the output changes dramatically.
So the DCF highlights the potential upside if management executes extremely well over the long term.
Precisely. It shows the theoretical value based on a specific set of optimistic but perhaps achievable assumptions. It's a framework for thinking about the possibility.
Okay, understood. That wraps up the fundamentals. Now let's move beyond the company itself and explore how the market views Hinge Health. Let's head into Chapter 4, Market Sentiment.
Right, market sentiment. Looking at Wall Street analysts, the view is overwhelmingly bullish, really quite positive. Out of 17 analysts covering the stock that we have data for, 15 rated a buy, 1 has a strong buy, and only 1 analyst is currently at hold. 0 sell ratings.
That's pretty strong consensus. What about price targets?
The average 12-month price target is $55.71, which is interesting because it's almost exactly where the stock is trading right now, at $55.76.
So analysts are bullish but think it's fairly valued for the next year?
That's what the average suggests. However, it's worth noting that after their strong Q2 results came out, some analysts raised their targets. For example, JMT Securities went up to $65. KeyCorp raised theirs to $60. That might indicate sentiment is actually improving, and the average target could creep higher.
And the general media tone? News coverage.
Since the IPO, it's been exceptionally positive. Lots of coverage, framing them as a successful market leader, an innovator. You could almost say they're in a bit of a honeymoon phase with the market and media right now.
Which can be good, but also sets high expectations.
Exactly. The bar is set pretty high for them to keep delivering.
Okay, what about other market indicators? Any data on short interest? Or what the moving averages are telling us?
Our sources didn't have specific data on short interest as a percentage of the float, but generally, high short interest would indicate a more contentious debate among investors, bulls versus bears fighting it out. Low short interest would suggest most investors are aligned with the bullish view.
And moving averages.
What we do know is that Hinge Health's current price of $55.76 is comfortably above its 50-day moving average, which sits around $46.21. That typically indicates strong positive momentum, suggesting the stock is in a technical uptrend in the short to medium term.
What about the 200-day?
We can't calculate the 200-day moving average yet. The IPO was only back in May 2025, so there isn't 200 days worth of trading history built up. That will become a more useful indicator over time.
Got it. So strong analyst support, positive momentum. Now, understanding who actually owns the company and how that might influence its future is crucial. This brings us neatly to Chapter 5. Ownership structure.
Yes, ownership is really interesting for Hinge Health. It's highly concentrated, which isn't unusual for a recent tech IPO that was previously venture-backed. The venture capital and private equity firms that funded its growth still hold a huge chunk, nearly 40% of the shares combined. Other institutions, like mutual funds and hedge funds, own about another third, roughly 33%.
So VCs and institutions own most of it. Who are the big names?
Top holders include well-known firms like Insight Venture Partners, Atomico, Coatue Management, Bessemer Venture Partners, Tiger Global. Basically, a who's who of tech investors.
What does that concentration mean for regular investors?
Well, on one hand, it's a strong validation of the business model. These sophisticated investors backed it heavily. But on the other hand, it creates a potential future stock overhang. Meaning, eventually, these early investors will want to sell their large stakes to realize their profits. That future selling pressure could potentially weigh on the stock price down the road, something to be aware of.
Okay, what about insiders? Management founders?
Insider ownership is also substantial, around 17.3%. The founders still hold large positions. CEO Daniel Perez has about 13.5%, and Executive Chairman Gabriel Mecklenburg holds just over 4%.
This seems like strong alignment with shareholders, right? Skin in the game.
Definitely. High founder ownership is usually seen as a positive sign for alignment. Now, you might see reports of recent dispositions by insiders shortly after the IPO, but those are often related to the mechanics of the IPO itself, covering taxes on vesting stock, things like that, rather than insiders actively choosing to sell shares on the open market.
Okay, so concentrated among VCs and institutions, but strong insider alignment. Anything else unusual about the ownership structure?
Yes, one very significant thing. The dual-class share structure. This is quite common in founder-led tech companies these days.
How does it work here?
There are two classes of stock. Class A shares, which is what the public typically buys, get 1 vote per share. But Class B shares, held primarily by insiders and those early VC investors, get 15 votes per share.
15 votes. Wow.
Yeah. The net effect is that the holders of Class B stock control approximately 97.1% of the total voting power.
So public shareholders have almost no say in governance.
Essentially, yes. This structure makes Hinge Health what's called a controlled company under stock exchange rules. The argument for it is that it allows management and the board to focus on long-term strategy without being swayed by short-term market pressures or activist investors.
And the downside?
The downside is that public Class A shareholders have virtually no influence on corporate governance matters, electing directors, approving major transactions, etc. The power rests firmly with the insiders and early investors holding the Class B shares.
That's a really important factor for potential investors to understand. Okay, we've looked at the business, management, financials, market view, ownership. Now let's talk risks and opportunities. Let's weigh them in Chapter 6, risk assessment.
Right. SWOT analysis, time strengths, weaknesses, opportunities, threats. Let's start with strengths. We've touched on many. That innovative tech platform, the AI, motion tracking, the clinical team, that's a core strength. Their dominant market position is another huge one, clear leader. Blue chip client list, strong brand recognition. And financially, those high gross margins, being free cash flow positive already and having that pristine debt-free balance sheet are major strengths.
Okay, clear strengths. What about the weaknesses? We flagged a couple earlier.
Yes. The most obvious is the lack of sustained GAAP profitability. Those heavy operating expenses, particularly the stock-based compensation, mean they're still reporting GAAP losses. That needs to turn around eventually. There's also an inherent dependence on complex technology, developing, deploying, maintaining AI, ML, wearables. It carries risks. Bugs, glitches, integration challenges, even future regulatory hurdles around AI in healthcare. And critically, as we discussed, those poor internal culture metrics, specifically that low executive team rating on Comparably. That remains a significant weakness, a red flag for talent retention, innovation, and potentially future execution.
Definitely a key weakness to monitor. Opportunities. We mentioned the TAM.
Opportunities are vast. That massive underpenetrated market is number one. Only 5% TAM penetration leaves enormous runway for growth just within their core market of large employers. Beyond that, expansion into adjacent markets looks promising. Things like selling to fully insured health plans, not just self-insured ones, or tackling the huge Medicare Advantage market. Strategic partnerships could also unlock new growth avenues.
And threats. Competition must be high on the list.
Absolutely. Intense competition is a major threat. Rivals like Sword Health are well-funded and directly challenging them. Omada Health offers a bundled approach. New entrants could emerge. Pricing pressure is always a risk in a competitive market. The evolving regulatory landscape is also a threat. While clearer rules can be good, unpredictable changes or increased compliance costs could hinder growth or impact margins.
What about broader economic factors like inflation, recession?
That's an interesting question. On one hand, inflation increases costs for everyone, including Hinge Health, and a recession could potentially slow down corporate spending or lengthen sales cycles. But Hinge Health's core value proposition is cost savings for employers. A solution that offers a 2x to 2.7x ROI on healthcare spend could actually become more attractive during tough economic times when companies are desperately looking to cut costs. So you could argue their model might be quite resilient, maybe even countercyclical to some extent.
Interesting angle. Any specific geopolitical risks?
Yes, one mentioned in the source material is quite specific and relevant right now. The U.S. imposed tariffs from 2025 on electronic components. Many of these components, potentially used in their wearable sensors or the ENSO device, are sourced from China and could face duties as high as 125%. That's a direct threat to their gross margins.
So.
They'd either have to absorb those higher costs, which hurts their profitability, or try to pass them on to clients in the form of higher prices, which could make them less competitive. It's a tangible, near-term risk factor tied to geopolitics.
Okay, that covers a lot of ground on risks and opportunities. We've been through the business, the management, the numbers, the market view. Let's try to bring it all together now. Time for Chapter 7.
All right, synthesizing everything. The bull case for Hinge Health rests on several strong pillars. They are the clear dominant market leader in a large and growing digital MSK market. They have a highly scalable software-like business model throwing off excellent gross margins and already generating positive free cash flow. Their competitive moat seems to be deepening, built on technology leadership, brand recognition, a growing data advantage, and high barriers to entry for competitors. Add to that a pristine balance sheet giving them flexibility and a founder-led team with significant skin in the game. It's a compelling growth story.
Okay, that's the bull case. What's the summary of the bear case?
The bear case highlights several key concerns. Intense competition is definitely one they won't have the market to themselves. The lack of sustained GAAP profitability is another. The market will want to see a clear path to bottom-line profits eventually. Those poor internal culture metrics we discussed are a significant risk factor that could impede execution. The dual-class share structure means public shareholders have very limited power. And finally, there's the tangible threat of margin pressure from those geopolitical tariffs on hardware components.
So clear arguments on both sides. How does valuation fit into this conclusion?
Well, as we said, the high-growth profile makes standard PE ratios difficult. They trade at a premium price-to-sales multiple, which bulls argue is justified by the growth and margins. That educational DCF model we talked about pointed to a potential long-term value around $127 per share, significantly higher than the current price. But again, that's heavily reliant on optimistic assumptions about sustained high growth and significant margin expansion playing out perfectly over many years. It highlights the potential upside if they execute flawlessly.
So, putting it all together, what's the concluding outlook?
As of our analysis date, August 31st, 2025, the share price of $55.76 is sitting right around the average analyst price target. This suggests the market is currently pricing in the known strengths and near-term growth prospects fairly accurately, according to consensus. There's no doubt Hinge Health is a compelling innovator tackling a massive market opportunity with a potentially disruptive model. But the ultimate long-term investment success here really hinges on management's ability to execute consistently. They need to capitalize on that huge market opportunity, navigate the competitive and regulatory landscape, address those internal culture concerns, and ultimately translate their market leadership into durable, profitable, and growing free cash flow for shareholders. That's the challenge and the opportunity ahead.
A very balanced summary. So thinking beyond just Hinge Health stock, what does this all mean for you, the listener? Maybe consider how Hinge Health's approach automating healthcare delivery, relentlessly focusing on proving ROI for clients, navigating this complex tech and regulatory environment, how that might be a template for other digital health solutions. Could their model, this blend of deep tech integration with a B2B distribution strategy focused on value, could that be the blueprint for the future of value-based care? Not just in MSK, but maybe across a whole range of other health conditions. Something to think about. And if you found this deep dive valuable today, we'd certainly appreciate it if you'd like this video and subscribe to the Stock Analytics AI YouTube channel. Remember, members who support us for just €4.99 a month get priority deep dives on tickers they request. We're planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those deep dives. And hey, if you just want a one-off deep dive on a specific company you're interested in, you can always drop us a super thanks on YouTube and we'll add it to our list.
And just our standard closing reminder, this analysis was generated by an AI system. It's intended for educational and informational purposes only and should absolutely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.